Doug Ramsey joining us. He's the Chief Investment Officer at the Luthold Group. So, Doug, as we like to do, I want to check in on your ways to gauge sentiment valuations in the market. Seems like we have the same conversation we did last time, which is a melt-up that continues to happen. How do we separate one part of the trend in the rally from another? Like, how do we know, when one is getting frothier than the previous, period of gains?
Well, we were there a couple months ago, and we just continued to blast higher. And the bifurcation in the market, and I like the way you talk about these quarantine stocks. It's really extraordinary. And if there were real confidence that this was going to be a broad-based economic recovery upcoming, you would see it in the stock market, and you don't. Instead, it's extraordinary the valuations you've reached with still this concentration in what are really fear-based, stay-at-home stocks. But in terms of options activity, it's incredibly speculative. If you drill down as to what small traders are doing, the speculative enthusiasm is greater than what we saw during the tech bubble. It's clear to me, in looking at some of the measures of professional participation, professionals are capitulating because they're lagging the Robinhood traders in performance. Not much has changed from when we spoke 2 months ago, other than that these sentiment measures and obviously the valuation readings have become more extreme than 2 months ago.
Doug, one of the charts that I like is the NASDAQ versus NYSE volume that your team put out on Twitter. Just a huge amount of volume that's focused in the NASDAQ. As you point out, and as we've been pointing out, that bifurcation, the month of July and a little bit in August, there was this kind of flirtation with rotation, I was calling it. That got stopped out big time as Zoom and these companies exploded. The background here, our COVID curves are going in the right way. Like, it's getting better. The economic data and the surprise rate is still at the record highs, judging by the surprise index. Are we starting to get to a point here where it's maybe departing from reality, these specific quarantine stocks?
I think that point was reached a while ago, quite frankly. And, it's interesting you measure the surprises. I don't really track the numbers quite that closely on earnings, but evidently the earnings surprise rate in the second quarter was the highest in history. Well, that's ridiculous. Earnings were abysmal across the board, other than, again, the pockets of stay-at-home stocks. It's all just about lowering the bar, and the same is true with those economic numbers. So I don't put a lot of stock in the surprise numbers, quite frankly. It's clear that on a rate of change basis, economic momentum has turned up. But the issue is, how long is it going to take us back to the activity levels we saw in January and February? I think it's going to be a very long time, and people don't appreciate the operating leverage, not to mention the financial leverage that has been put in place during this cycle that's only been exacerbated during the downturn because the Fed has encouraged it. That's very unusual. During a downturn, you normally have a rationalization of debt levels, write-downs, and things of that nature. Instead, they've encouraged companies to become more and more leveraged.
Doug, one of the things I wonder here is that when you look at the everything trade of the market, which has been over the last 6 months, it's starting to break a little bit with gold coming off somewhat, but basically NASDAQ, gold, Bitcoin, bonds, they're all higher together. That was the story in 2019 as well. We lost the dollar to that trend as the dollar started to break down. But part of me is like, okay, well, this bifurcation in the equity market, does it at least set up maybe a kind of non-correlated asset class of small caps or value in a way that if there is some dynamic shift that hurts these high-flying tech companies, maybe that's the way to go? That's a possibility, but then I look at this chart you've got for indebted companies, and it looks like all the zombies are roaming in the small cap space.
They are, and they're doing something rational. They've been subsidized to run these money-losing business models. So just the change that's shown, the past couple of years has really been incredible. As a matter of fact, we've traced the percentage of money-losing companies across the entire universe. It's very strongly correlated and inversely correlated, and I'm getting a little bit down in the weeds here, to real interest rates. In other words, when real interest rates, short-term interest rates are negative, as they are now, because we've got a little bit of inflation. We've got about 1% inflation and around zero rates. So short-term real rates are negative. I mean, that just subsidizes these money-losing companies. So, I mean, still, I believe that when a real recovery takes hold, I mean, the stock market is clearly not seeing it based on the concentration in these stay-at-home stocks. But I do think you'll see a rotation, and it may not be so much value and small caps going up that much, but I think you're going to see a big deflation in the multiples on these large cap growth stocks. I mean, that sounds unusual in an economic recovery, but it happened in 2002. The recovery started in December of 2001, but we had a big washout culminating in the market low of October 2002 because the bear market and recession did not fully devalue those large cap growth stocks. So something like that could happen. It'd be unusual for that to happen in an economic expansion, but it's happened before when we got this incredible bifurcation in the market. So it could happen again.
And the setup seems like it would be reasonably comparable to that period too, with valuations in the market only comparable to .com, right? Right,
absolutely. And you know, in some measures, they've exceeded .com. I mean, price to sales on the S&P 500 is now 2.4. That takes out the old March of 2000 peak. Price to cash flow, and part of it is just because cash flow has been decimated, but the S&P Industrials cash flow ratios at a new all-time high. And there are a couple measures. Our normalized earnings today is hitting 30 times earnings today. The all-time peak was 34. So certainly there's precedent to go a little bit higher on some measures to get back to those bubble peaks, but we're about there. I mean, if you look at the broad spectrum of things, which is what we like to do on a valuation basis, we're there. We're right back at March of 2000 type valuations.
Doug, some of the sentiment measures are also getting quite elevated. A lot of folks have pointed out put to call. I know your team tracks that as well. We've discussed that one here a little bit. Some of the survey measures are also quite elevated in terms of bulls versus bears on AAII, et cetera. Now, in terms of what those mean as predictive tools, I know sometimes they're pretty decent, but also it seems like the last 3 or 4 months, I'm not sure where it stands right now. I'd love to hear if you do, but one of the things we kept harping on was the cash, and all the measurements for cash piles, though, were also pretty high. So it seemed like the idea of putting money to work somewhere was overpowering some of these lofty sentiments. We were looking at some of the money market funds, and still just a lot of money parked that wasn't even in stocks. Now, I think now a lot of it has made its way in, but how do we gauge those, the kind of sentiment versus where people are actually putting their money to work? Because if there's money going to work, it seems like it's only going to one place, and it's basically the Qs.
That's true, but I mean, those cash piles are still going to be there. I mean, someone's got to hold them. They may be dumping them off, and I suspect what's going on, I mean, the smart money is moving into cash here at these valuations. So, I mean, that money mountain that some people talk about, it's not going away. I mean, it's an asset. And if you look at cash holdings by equity mutual funds, I mean, occasionally, you know, there's reason that these managers believe to have a cash buffer. I mean, it's a good way to the unemployment line for a lot of fully invested equity managers to hold any cash. But that cash buffer by equity managers is near an all-time low. But you're right in terms of some of these, you know, that chart you're showing may be from a couple of months ago, and it's just gotten more and more extreme. It's probably one of the more extraordinary market moves off the sentiment extremes we were writing about 2 months ago. But I have to say, it's been largely concentrated in the NASDAQ stocks. I mean, keep in mind, Oliver, the S&P 1500 equal weighted index, and boy, do I wish that thing was my benchmark, it's down 7% year to date versus large cap growth up 30. It's really, again, I mean, the only thing that holds water to it is late 99, early 2000. So you haven't, I mean, the broad market hasn't had a big move since you hit these sentiment extremes a couple months ago. It's really just been, you know, the strong getting even stronger.
Doug, how much of this over the last couple months, the extension of the move. I mean, really vertical moves in some of these quarantine stocks, et cetera. To your point about what's happening, zombie companies too connects in with a situation from monetary policy that has been so profound. It seems the market, even in the face of incipient inflation, is giving an okay that the Fed is going to hold rates where it is. How much of the rest of the market outside tech, how much of that potential is tied to rates? I mean, are we ever going to get that type of reversal if the Fed is pinning down rates? Or is it possible there could be enough economic strength where the market does revolt a little bit, and whether or not the Fed does move, rates start to climb? I mean, it just seems like when you look at some of the value composition, there's a lot of companies here, especially banks, et cetera, that want these higher rates. But again, even after move in August, they're just flat and still have negative real yields.
Yeah, I'll concede it's very hard to envision, and that's why the value opportunity is there, because almost no one can see that type of scenario where you could have, even a doubling of 10-year bond yields doesn't even get you to 150. So I don't know. I suspect at some point global markets revolt at the amount of debt that the U.S. Treasury is dumping onto us, and that could be a combination of rising rates and a falling dollar. And that, certainly that's why you're seeing gold and silver, and more recently, Bitcoin has caught up with gold and silver of late. So these alternative forms of alternatives to fiat currency are perking up. But yeah, it is very hard for me to envision rates going up sharply. But the Fed does not control the long end of the market. And at some point, I do think there's going to be a revolt against what in practice, to me, and I don't get into the weeds on this, but in practice we have modern monetary theory here, where we're just, Fed is beholden to congressional budget outlays.
Sure. Doug, I know that you guys have some interesting charts in the report, and one of them I saw about gold potentially not even reaching some of the previous valuations in terms of how much it is to buy a house. That's pretty interesting. I love that chart. We got to go there, Doug. Really good stuff. Always good to get your take here. Appreciate you putting it in perspective for us. We can keep going. The Luthold reports are deep with analysis. Thank you, Doug Ramsey.